Well, for chapter 4, I wanted to go over some problems with you, just the same type of thing we did in class the other night. So I'll just have our ebook open to the computational exercises, starting out with the first one, number 19. And you can see here what it says. So Marie and Ethan from Roundtree Corporation form Roundtree Corporation with a transfer of the following. Marie performs personal services, fair market value of $80,000 in exchange for 400 shares of stock. Ethan contributes an installment note receivable, a basis of 25, fair market value of 30, land with the basis of 50, fair market value of 170, and inventory with the basis of 100 and fair market value of 120 in exchange for 1,600 shares, so a total of 2,000 shares between the two of them. Determine Marie and Ethan's current income, gain or loss, calculate the basis that each takes in the Roundtree stock. So a little bit longer calculation to do some of these, so I'm just going to just open up a blank Excel file to do this. And so for Marie, remember that she transferred services and she received 80,000 worth of the stock. So let me just go back to that real quick here. Hit the right button. There we go. And so because Marie contributed services and she received $80,000 worth of the stock, that is ordinary income to Marie. Okay. The value of our services provided. So it's basically just like taxable income, only instead of receiving cash, she received the 400 shares of stock. For Ethan, though, different story, because Ethan will meet the 80% rule. And so key thing to remember there, right? So the 80% rule. So Ethan's receiving 1,600 out of 2,000 shares. That's the 80% rule right there. So he's getting the 80%. Which I'm sure they designed that way on purpose when they issued the shares. And so for Ethan, let's go back and look at Ethan's numbers here. So for Ethan, he's going to have a gain that he can defer. Okay, and so he's going to defer a realized gain, and his realized gain will be as follows. And what he's getting is $320,000, and that's made up of three things. Okay, I mean, just full disclosure, I'm using my Mac, which does not have a full keyboard, so I'm a little bit slower on numbers with this thing than I am with my other computer. Okay, so what he contributed, the fair market value was $320,000. Okay, 30, 170, and 120. Okay, then we subtract a couple of things. So here's his fair market value less the installment note. Okay, less the installment note. Let me just make that a little bit bigger here. And the installment note had a value of 25,000. Then the land. So we're still saying less on the land. And then inventory. And that's 100,000. And I'm abbreviating a lot here. So my gain is this. So my gain is just the sum of all these things. Okay. So add those up. I've got a gain of 145, and he can defer that gain because he's 80% owned, right? So there's 2,000 shares total. He has 1,600 of the shares. So clearly it's 80%. I'm just going to show you. There we go, 80% exactly. So what he then does is that he can defer that gain by the 145,000 gain. His basis in the stock, just so you know, is 175. So let's go back to the question. His basis is the sum of the three basis numbers, basis of 25, 75, and 100. This is basis in the stock, and the fair market value was the sum of the fair market value numbers, the 30, the 170, and the 120. Okay, so that is question 19. Let's take a look at question 20. Grady exchanges qualified property basis of $12,000 and fair market value of $18,000 for 60% of the stock of ED Corp. The other 40% of the stock is owned by Pedro, who acquired it 5 years ago. Calculate Grady's current income, gain, or loss, and the basis he takes in his shares of ED stock as a result of the transaction. So first of all, I'll be thinking, does this qualify as a Section 351 transfer? And the question is that it does not. Okay, it does not qualify. And it does not qualify because Grady does not control ED Corp immediately after the transfer. Okay, because we did not meet the 80% rule. Therefore, he's going to have a gain. Okay, so therefore he's going to have a gain that he will have to recognize. And so what the gain will be, and I'll just describe this one, is the fair market value of the stock of $18,000. So fair market value of $18,000 less the property transferred, which is the basis of $12,000. So the $18,000 minus the 12 is a $6,000 gain realized. Then all of that gain is actually going to be recognized now because he did not meet the 80% rule. So the transaction is fully taxable to Grady. His ED stock basis is $18,000, the fair market value. Okay, so that answers question 20. Question 21, it says that Jocelyn contributes land with a basis of 60 and fair market value of 90 and inventory with a basis of 5 and fair market value of 8 in exchange for 100% of Zion Corp stock. The land is subject to a $15,000 mortgage. Determine Jocelyn's recognized gain or loss on the basis of Zion stock received. So for 21, the contribution is tax deferred under Section 351, which I'm making everybody probably figured that out because there's 100% here. So he definitely met the 80% rule. So she receives Zion stock worth $83,000, and the $83,000 is the value of the land and inventory transferred, reduced by the debt relief. Okay, so she receives the value of 90, fair market value of 90, and fair market value of 8, subtracted by the mortgage of 15. Okay, so 83,000. So 90 plus 8 minus 15 is 83,000. So that is her value of the stock. So her gain on the stock will be the 83,000 plus the $15,000 mortgage for the 98 minus $60,000 basis in the land minus the $5,000 basis of inventory, and that will be $33,000 gain. All that gain can be deferred because she met the 100%. She met more than 80%. Okay, so her gain again, let me just say that again, was $33,000, which is the value of the stock of 83, plus the release of the liability, the mortgage of 15, that's 98, minus the basis in land of 60, minus the basis of inventory of 5. That's a net gain of 33, which can be deferred. Question 22 says Martin transfers real estate with an adjusted basis of $260 and fair market value of $350 to a newly formed corporation in exchange for 100% of the stock. The corporation assumes a liability on the transferred real estate in the amount of $300,000. Determined Martin's recognized gain on the transfer and the basis of his stock. So Martin's transfer of real estate to the corp is a 351 transaction. Hopefully you saw that with the 100% number there. The amount realized of 350 is basically his stock. So basically he's got a stock with basically tripping over my words here. So his stock is worth 300,000 right here, and so what we're doing is his realized gain is 300,000. Let me say the market value of 350. Let me say that right. I don't know why I'm not seeing that. The market value of 350 minus the basis of 260. Okay, that's $90,000. That 90,000 then is his gain that he realized. The basis of his stock, though, is 0. And the reason the basis is 0 is the basis is 260. The release of the liability was 300,000. And then the gain recognized is 40,000. And the gain recognized is the 300,000 minus the 260. So this one I'm going to actually just show you in Excel again. So this one's a little bit more confusing. Okay, so go to 22. I'm just going to go back to Excel and do this one here. I'm just going to scroll down a bit. So we'll just start down here with this one. So question 22 in the Excel, what he's realizing is the market of 350. So 350. And then he's going to subtract the adjusted basis. So our less real estate adjusted basis. Okay, that's minus 260. And that's his gain. So that gain clearly is 90. His gain recognized is this number. And his gain recognized is the liability relieved is in excess of what he transferred. So we have to take 300,000 and subtract 260. If I hit the right keys, that would help. Okay, so 300,000 minus 260. And so the gain he has to recognize is 40,000. Okay, his basis then becomes this. It's the original basis of 260 minus the release of the liability plus the gain, plus gain recognized. And that's going back to my 40,000. So his basis is actually now 0. Okay, so I didn't mean to trip over that one, but there's more going on than I realized. So he realized 350 because of the fair market value of the stock of the land. Because his release is 260, his gain is 90. He has to recognize 40,000 of that, and the reason for that is because he's relieved of a liability that exceeds the basis of the asset transferred. And so he has to recognize a gain to the extent of the excess of that. The 300,000 over the 260 is a $40,000 gain. Okay, so that was 22. 23 is Yvonne and Simon form Ion Corp. Yvonne transfers equipment, basis of 110, fair market value of 165. Simon invests 130 in cash. They each receive 100 shares of Ion Corp worth 130 each. Yvonne also receives 35,000 in cash from Ion. Calculate Ion's basis in the equipment. In addition, determine Yvonne and Simon's basis in the stock of the company. It is subject to the Section 351 treatment because Yvonne receives boot in the transfer, though she recognizes some gain. So hopefully everybody saw that. Because she's receiving some cash back, she's going to have to recognize a gain on that $35,000 of cash received, which will produce a basis in the stock of $110,000. So let me just show you how we do that. So I'm just going to scroll down a bit here to get to a blank area of the Excel here, just so we can start fresh. Okay, so we're looking at Ion Corp, and so the amount realized I didn't spell realized very well, but you know what that means. And we receive stock and cash. So the stock was worth 130, cash at 35. Okay, so a total of 165. Everybody should see that. We subtract from that then the equipment basis, and then we also subtract from that, I'm sorry, we don't subtract, that's our gain. Okay, so our gain then is the sum of those two items for 55. That's the total gain. The gain recognized is the cash boot of 35. Okay. Then Yvonne's basis in the stock was the other part of the question. And Yvonne's basis is, the basis of the asset transferred is 110. Okay. And then plus the gain of 35, the cash received, minus the boot. Okay, which happens to be the same number. So it's plus 35 minus 35. And of course then the basis is just 110. Okay, that just adds up to be 110 even though I typed in the number. So Ion takes on a basis of 145 in the equipment received, the 110 plus the 35. Simon's basis is 130, the amount of cash that he paid. So basically Yvonne's basis is 110, Ion's basis is 145, and then Simon's basis is 130. Okay, that was question 23. Let's take a look at 24. Okay, for this one it says that Chaz transfers cash of $60,000 to a newly formed corporation for 100% of the stock. In its initial year, the corporation's net income of $15,000. The income is credited to earnings and profits. The corporation distributes $5,000 to Chaz. How did Chaz and the corp treat the $5,000 distribution? That's first part, and then assume that instead Chaz transfers to the corp cash at $30,000 for stock and cash at $30,000 for a note of the same amount. The notes payable and equal annual installments of $3,000 each, beginning at the end of the corp's initial year of operations, and bears interest of 6%. At the end of the year, the corp pays an amount to meet the obligation, determine the total amount of the payment, and his tax treatment to Chaz and the corporation. So let's look at Part A first. How does he treat the $5,000 distribution? So hopefully everybody could just see it's a dividend. It's basically what that is, right? They just basically, they made $5,000 and they distribute it right back to Chaz, the owner. And so that is a distribution of the corporation's earnings and profits, E&P. And his tax is a dividend to Chaz. The corporation, of course, cannot claim a deduction for that. It's a little bit different story. So hopefully everybody just kind of saw that. Chaz is paid a dividend by the company. Chaz will have to pay a dividend, or I'm sorry, just pay a tax on ordinary income for dividends. For Part B, a little bit different though. The corporation payment to Chaz is $4,800, $1,800, which is interest, which is $30,000 times 6%, and $3,000 in annual note payment. So they're going to pay him $3,000 per year plus 6%. Okay, 6% interest. So 6% times 30,000 is 1,800. Therefore, Chaz recognizes $1,800 worth of interest income on the receipt of the $4,800 payment. $3,000 is not deductible because this is a return of principal. So of course it's not taxable to him. He's just receiving his principal back. But the $1,800 is taxable interest income. Because it's taxable to him, the $1,800, of course the corporation can deduct that as interest expense. But the repayment of the $3,000 would not be deductible. So hopefully just kind of recognize that as a borrowing, right? Just a bank could have lent the money to the corporation, but instead the owner did. And so the corporation is now paying back Chaz for the principal and interest. The principal returned is not taxable, but the interest returned to Chaz is taxable income for him. And for the corporation, they can deduct interest expense. Question 25 is the next one. Let me get that all on the screen here. Several years ago, Lowell, who was single, acquired Section 1244 stock in Blue Corp at a cost of $60. He sells the Blue stock for $5 in the current year. Determine the amount and nature of Lowell's gain or loss recognized this year. So for this one, it's fully taxable transaction, which produces a loss of $55,000. Okay, so basically he realized $5,000 in cash, but his cost was $60. So hopefully everybody sees he lost $55,000 on that. So loss realized and recognized would be $55,000. Just to explain that one a little bit, typically stock investments are considered capital assets, and gain or loss is recognized on disposition would be given capital gain or loss treatment. However, because Blue stock is Section 1244, which is considered to be small business stock, up to $50,000 of the loss, or $100,000 for a married taxpayer filing jointly, is given ordinary treatment. Okay, so therefore this is a $55,000 loss. So as a single taxpayer, which they mentioned to Lowell, is ordinary loss is $50,000 and capital loss is $5,000. Okay, so ordinary loss of $50,000, capital loss of $5,000. For 26, what I think I'm going to do is provide the answer for this one to everybody in a written document. This one's a little bit longer, and I think this one would just be easier if I just gave out the answer for it. So for problem 26, just be looking for that. I will do that, and I think that'll make more sense. And the same thing for the next one, 27. So what I'm going to do for 26 and 27 is just provide the answers for those two. I think that'll be a little bit more meaningful for everybody if they just see those as opposed to me trying to explain it in Excel and all that good stuff. These are a little bit longer. So 26 and 27, I'll come back to those. And then let's move on to 29. Oop, I went too far. Did not me. I should not have hit right. I should have just scrolled down. Let me get back to 29. I'm skipping 28, just FYI, but 26 and 27 I will provide the answers. I'm skipping 28 on purpose. So let's take a look at 29. Um, 29 says, and this is a communications question, and it says Michael Kennedy, the address, exchanges property with a base of $200,000 and a fair market value of $850 for 75% of the stock of Red Corp. The other 25% is owned by Sarah Mitchell, who acquired it several years ago. You represent Michael Kennedy, who asked whether he must report a gain on the transfer. Prepare a letter to Michael and a memorandum for the tax files documenting a response. So I'm not going to go through all the gory details of that, but I'm going to just kind of pick on the highlights with this one. Okay, so just to think about it, transferred property, exchange of basis of $200,000 for fair market value of $850, 75% control. So the key is, hopefully everybody was thinking the 80% rule when you read that 75. So that's obviously a big deal. And so it says because the stock you acquired represents less than 80% interest in Red Corp, you must report gain on the transfer. And hopefully everybody saw that. Your gain will be $650, which of course is $850 minus $200, the value of the stock received. So your tax base is $200, your fair market value is $850. So you have to pay a tax on the $650,000 difference. Okay, so that's just the very simple answer to that one. Let's take a look at 30. Dan and Patricia form Crane Corp. It says here, Dan transfers land worth $200,000, basis of 60, for 50% in the stock of Crane. Patricia transfers machinery worth $150, adjusted basis of 30, and provides services for $50,000 for 50%. So they each get 50%. One transferred land, the other put in machinery and services. Question A, will the transfers qualify under Section 351? And hopefully you're thinking yes, and you're thinking yes because the 50 and the 50 are 100%. Clearly more than the 80% required. And the key thing here is the property that she transferred has a much higher value than the services transferred, right? So, you know, the machinery is worth $150 with the basis of 30, clearly higher than the services she provides. So it still qualifies, even if you're thinking that might have been a disqualifier. It was not in this example. Question B, what are the tax consequences to both Dan and Patricia? Dan has no gain on transfer of the land. His basis in the Crane stock is 60, which is his basis in the land. Okay, so his basis is 60. Patricia recognizes compensation income of $50,000 in the transfer, okay, because of the services she provided. Even though the transfer of the machinery qualifies under Section 351, her transfer of services for stock does not. Patricia has a basis of $80,000 in her stock, which is the $30,000 basis of the machinery plus the $50,000 value of her services. So her basis is $80,000. Question C, what is Crane Corp's basis in the land of the machinery? Crane Corp has a basis of 60 in the land, that's an easy one, and a basis of 30 in the machinery, just simply the basis that Patricia transferred. Crane either has a deduction of 50 in the services provided by Patricia, or has 50,000 to capitalize as organizational expenses. So they can elect how they want to treat the 50,000 that Patricia received. They can either just say it's a business expense or capitalize it as organizational cost, kind of up to them. The next one is 31. In this one, John organized Toucan Corp 10 years ago. He contributed property worth $1 million, basis of $200,000 for 2,000 shares of stock in Toucan, which is 100%. John later gave each of his children, Julie and Rachel, 500 shares of the stock in the current year. John transfers property worth $350 with a basis of $170 to Toucan for 1,000 more shares. What gain, if any, will John recognize in the transfer? So what he gave up was worth $350 with a basis of $170. So obviously everybody should be thinking difference there between those two numbers is 180. Okay. And so that's it. He must recognize a $180,000 gain on the transfer. Okay. The transfer does not qualify for Section 351. Even though he originally owned 100% of the company, he only owns 66 2/3 after the transfer. Basically, there's 3,000 shares total floating around, and he now owns only 2,000 of those shares because he did own 2,000, which is all of them. He gave 1,000 shares away to his children. After the transfer, he owns 1,000 more shares, so a total of 3,000 shares are floating around. He owns 2,000, his children own 1,000, so he owns 2/3 of the company, basically 66 2/3. So it does not qualify as Section 351. Okay, so that was 31. 32, the next one right there, let me get it all on the screen. Ann and Bob form Robin Corp. Ann transfers property worth $420 with a basis of $150 for 70 shares in Robin Corp. Bob receives 30 shares for property worth $165, a basis of $30, and for legal services worth $15 organizing the corp. So, just like before, a few questions here. What gain or income, if any, will the parties recognize in the transfer? So you can see here that they did transfer, 70 shares plus 30 shares, so 100 shares. So that's important to know. And does not recognize a gain. Bob does recognize ordinary income of $15,000 for the legal services that he provided, the services that he rendered. Bob does not recognize a gain in the transfer of the property in the corporation because it does meet the 80% rule clearly. For B, what's the basis in the stock for Ann and Bob? Ann has a basis of $150, basically the basis of the transfer, the basis of the property that she transferred, which is $150. That's her basis. Bob has a basis of $45, which is $30,000 in the property that he contributed, plus his $15,000 worth of legal services. So Bob's basis is $45. Question C, what is Robin Corp's basis in the property and services received from Ann and Bob? Robin Corp has a basis of $150 in the property from Ann, just simply the basis she transferred, and a basis of $30 in the property received from Bob. And then Robin can capitalize the $15,000 as organizational expenditures, or they could just expense them if they wanted to. Okay, that's question 32. Let's see, question 34 is the next one I want to go over with you. Let me scroll down here to get to 34. There we go. For 34, Kim is an employee of Asia Corp. In the current year, she receives cash salary of $30,000 and also is given 10 shares of Asia stock for services she rendered to the corporation. The shares in Asia Corp are worth $1,000 each. For tax purposes, how will Kim treat the receipt of those 10 shares? And what is Asia Corp's total compensation deduction for Kim's services? The answer is, in addition to her cash salary of $30,000 that Kim receives right there, the $30,000, she has ordinary income also of $10,000, 10 shares of stock in the company that are worth $1,000 each. Asia Corp has a compensation deduction of $40,000, which is the $30,000 plus the $10,000. Okay, let's take a look at the next one we'll look at is 38. Right, oops, went too far. Okay, so question 38. Allie forms Broadbill Corp. by transferring land, basis of $125, fair market value of $775, and subject to a mortgage of $375. 1 month prior to incorporating Broadbill, Allie borrows $100,000 for personal reasons and gives a lender a second mortgage on the land. Broadbill Corp issues stock worth of $300,000 to Allie and assumes the mortgage. So question A, what are the tax consequences to Allie and to Broadbill regarding the transfers and all that good stuff? For this one, Section 357 parts B and C are applicable. The land is subject to two mortgages that are in excess of the basis, causing 357C to apply. Allie has a gain of 350, which is 375 plus 100,000 minus 125,000, basically her basis. So let me say that again. Her basis is, her gain is 350, which is 375 plus 100 minus 125. She's also, because she also borrowed 100,000 before incorporating and used the funds for personal reasons, Section 357B applies. Section 357B causes all liabilities to be tainted, so therefore Allie has boot of 475. This generates taxable gain of 475. The amount of the boot, her realized gain is 650, $300,000, which is the value of the stock received, plus her gain of 475 for a total of 775, minus the release of liabilities, which is the $125,000 basis in the land. The realized gain is taxed to the extent of the boot received, or at 475. Okay. For Broadbill, then, they have a basis of $600,000 in the land, which is the $125,000 carryover basis from Allie, plus the 475 gain recognized to Allie. So the sum of those two is 600,000. For B, how would the tax consequences to Allie be different if she had not borrowed the $100,000? Then 357B would not apply. Under Section B, 357B would not apply had she not taken out that second mortgage. However, 357C would apply. Allie would have taxable gain under 357C of 250, which is the 375 of liabilities, the mortgage assumed by the corporation, minus the $125,000 basis. So the 375 mortgage minus the basis of 125 is 250, and that is the taxable gain that Allie would have had in that scenario. Allie's basis in the stock would be 0, which is the 125 basis plus the 250 gain minus the 375 liabilities assumed. Broadbill would have a basis of 375, which is the 125 carryover basis from Allie, plus the $250 gain, or $250,000 gain recognized by Allie. So there's a lot going on with 38, but just in that one we deal with 357, B, and C. Okay, let's take a look at just one more. We'll look at 39. That'll be our last one. Okay, Raphael transfers the following assets to Crane Corp in exchange for all of its stock. Actually, you know what? This one I am going to just give you the answer for. There's a lot going on with this one, as I meant to say that before. So this one I'm just going to provide you the answer in a Word document, and I'll send that out to everybody. For some of these are just so long, I think that'll just be easier. I'd put them on the screen if we were in the classroom, but since we're not, we'll do it that way. So I'll send that one out. Hopefully those made sense. I hope it just kind of give you some practice for doing these. And as always, if you have questions, just let me know. Thanks.